When people hear about whole life insurance, they think, oh my God, I'm not going to be able to make that premium payment my whole life. Yes, we know. You're not going to have to. You can't. If the policy is structured in such a manner that more money is going to pay up additions, you can't. Hello, and welcome back to the podcast. Thank you very much for being here. All right, today we're going to talk about a subject apparently I've never talked about, and I don't know why I've never talked about it, but we're going to. First of all, couple things. One, if you go to Spotify, now you can see the video of me. So if you want to watch any sort of animations, you can go to Spotify and ditch that Apple thing. And two, I hope you had a fantastic Thanksgiving and nobody killed one another. All right, so today let's talk about why the premium drops in my case studies. Everybody asks this question. Clearly, I have never thought to do a podcast on it. So when we look at Dawn and Anita, and we look at their illustration, it goes from $100,000 a year, and then it goes to 50, and then it goes to 25. When it goes to 25, that is when that policy becomes a modified endowment contract. So if they were to put in an extra $75,000, the entire thing would grow taxable. So what that means is when they go to borrow money, any money that they borrow will be interest first, and they'll have to pay tax on that. We don't want to have to be paying tax. And so what we do, and I don't do this all the time, it depends on the client, how the policy is structured. Where are we at financially? I've done podcasts in the past of a 25-75 split, a 50-50 split, depending on what the client needs. But in this scenario, in the book, I did a 25-75 split. 75% of the premium is going to the paid up additions rider. So that means we're filling that thing full of cash value as soon as we can, and it's going to mech, and then we're going to pay base only. So as soon as we get that thing full, then we have to back off, and then in this scenario, he's paying $25,000 the rest of his life. So when people see this, or when people hear about whole life insurance, they think, oh my God, I'm not going to be able to make that premium payment my whole life. Yes, we know. You're not going to have to. You can't. If the policy is structured in such a manner that more money is going to pay up additions, you can't. Now, if you look at Lane's illustration, it's a little bit different. He can pay that $12,000. He's paying it for 30 some years. That is because it does not mech there. And so if I do a policy that is more of a 50-50 type split, 50% to whole life base, 50% to paid up additions, we may be in a position where we can pay that premium our entire life. There are times we want to do that. There are times where I purposely set the policy up that way because the person I'm talking to doesn't need all the cash right away. They're like, hey, it's okay. I don't need to use it. It's excess money. I'm not using it now. It's just sitting in an IRA or a savings account or whatever. And so that's fine if you want to do something where we're going to be able to transfer, or we're going to be able to pay premium forever. Why would we be in a position where we're 80 or 90 years old wanting to pay premium forever? Well, maybe we're going to sell the farm and we're going to have all this money and we're not going to know what to do with it. Maybe we have a business outside that we're going to have shares of that business that's going to constantly income be coming in. Maybe we have a lot of Social Security. Maybe we have a lot of money in IRAs that are going to require required minimum distributions from. And so what's happening to the big picture of what's going on in your finances? This is why I meet with you guys. I don't meet with you trying to sell you something. I meet with you trying to help you figure out, how do we structure that policy? What does that look like? But when we structure these policies, we don't want them to be a mech if we can help it. So again, it's not the end of the world if it is a mech, but we don't want it to become a mech. So if you are seeing an agent, and we just came across this with somebody that has policies with a different agent. And instead of illustrating the premium going in their whole entire life, which it could without it mecking, they were dropping that off. Your paid up additions rider and your premium does not need to reduce unless it's going to mech. And it will show on any illustration, doesn't matter what company it's with, it will show that. Now, I started writing with a different company for New York, and that company automatically reduces it at the time of a mech. I don't even have to think about it. I run it, it reduces it, it shows me. That's fantastic. And so it won't allow it to mech because I think there's a little check mark that says, don't allow this to mech. Here's a big deal too. You have people that have what they call a 1090. So they're putting even more money than I am. They're putting 2 paid up additions. Well, all that does is it moves the mech up. So instead of it meching maybe in 20 years, it's going to mech in 10 or something like that, which then means we have to start another policy. That also means that we're so close to the mech that if we changed from annual to monthly, that could mech the policy. I have a policy like that. I got it so close to the mech that if this person changes from monthly to annual, it'll mech the policy. Totally my fault. It was one of my very first policies. And I was just trying to hug the mech, right? Because I wanted as much money in as I could, and that was not good. So we want to make sure, or we want to understand that if we're buying a policy, that's going to drop down and we're not going to be committed to that big premium our entire life unless we want to. Even if I'm doing a 50-50, if you have the ability to put that money in your whole life. That doesn't mean that you have to. So when you're looking at the book and you're saying, well, Mary Jo, why does this premium drop? If you're reading my Life Without the Bank book, you will see in that book as well that the premium drops. And why are the premiums dropping? Because we're giving you all of this money up front instead of making you wait longer. So the less money we put to PUAs, the longer that whole thing takes. Now, again, I've said it a million times and I'll keep saying it. A traditional whole life policy that pays dividends is not any worse than what I'm selling you. At the end of the day, they're both good policies. It's just a matter of we're putting that paid up additions rider on to give you access to money faster because your need for finance today is probably greater than your need for death benefit. Now, we're probably going to kill both birds with one stone. We're going to get you a bunch of death benefit and we're going to get you the cash value that you. So it's not that piece of it for me follows along, but you definitely want to understand what's happening within the policies and where the money's going, because I'm just seeing people that are saying, oh, well, I'm not going to put as much money to paid up additions. And then they put more of that money to the traditional base piece of the policy. And that is just a commission maker. Like, in my opinion, unless you need to, because we have these things going on later in life and we want to be able to put money somewhere, do we need that today? If we haven't asked the client all the right questions, if you haven't been in a meeting with somebody before you buy your policy, if you are not talking to your agent for over an hour before you buy your first policy, how do they know what you need? It takes me an hour and a half to figure out what you guys need, family dynamics, all of the above. If someone's not doing that, then are they just selling you a policy? How do you know what's right? How do you know it's structured right for your needs? So there's that. But if you've ever had that question, why is that illustration or why is that premium dropping? Because the premium cannot ever go higher, but the premium can go lower. And so if you're wondering why is that premium going lower, that's why. All right, you guys, that's all I got for you today. Let me know if you have questions, comments, concerns. Happy to answer those. You have a fantastic rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.